Hello and welcome everyone to our third webinar of our series. This one is all about tax planning for 2021. As we come into the end of the financial year, it's a perfect time to look at different strategies to reduce your tax, grow your wealth and increase certainty. I'm going to close that because we're going to constantly look at it. Yeah. So your webinar hosts, so myself, Teresa Allery, and Leishan Smaller, we are both directors at Element Business and Accounting Solutions, and we're here to talk to you all about tax planning. So, using Zoom features. If you're not familiar with the Zoom environment, you will see a few buttons on your screen. So throughout this webinar, we will be raising a bunch of topics. We're not really going to use the chat or the raise hands function, but if you have any questions, feel free to put them through the Q&A section over here. We will attempt to answer as many questions as we can at the end of the webinar, depending on time. If you need to leave the meeting at any time, you can press the leave meeting button and you can rejoin using your original link. Not press it, click it. So over to you, Leishan.
Okay, so the thought of the day is effective performance is preceded by painstaking preparation. And this is a quote by Brian Tracy, who, as some of you will be aware, wrote a book called Eat That Frog, which is all about fighting off procrastination and digging our head in the sand for what we all know is to come. He also wrote another quote, which is successful people, are simply those with successful habits. And we here believe that doing tax planning and proactive tax planning is an example of a successful habit for a very successful business.
That's right. And I think the painstaking preparation, it's one of those situations with tax planning and with any planning you do for your business, the more you put in, the more you'll get out of it. So, taking you through today's agenda and what we'll be covering in this webinar. So the first thing we're going to cover is we're going to start right at the beginning and discuss why tax planning is so important, and especially why it's so important this year. Then we're going to take you through some key strategies for personal tax. And then the crux of our webinar is we're going to be taking you through a number of different strategies for business tax. We're also going to do a deep dive into two key issues, which is all around the importance of trust distribution resolutions and why they must be done by 30 June. And also another strategy which we often implement for our clients, which is all about minimising tax using bucket companies. We'll then talk about the way forward and what your next steps are. And right at the end, if we've got some time, we'll answer a few questions for you. Oh, sorry, disclaimer, I always forget. So one thing I have to remember is before we get into the webinar is we have to go through the disclaimer. So please remember that the information in this educational webinar is general in nature and is no substitute for specific tailored advice and support. We'll also be covering a number of superannuation strategies. We note this webinar is tax planning advice and not financial advice. If you want some tailored advice, feel free to work with us one-on-one so that we can help identify the most important actions that you can take to make the biggest impact for you and your business moving forward. So straight on to why tax planning is so important. So I didn't know how to unfade that. It's something in how tomorrow's put it together.
Okay.
But yeah.
So as Teresa said, we're going to start off with why is tax planning so important? So our number one reason is we can estimate how much you have to pay in tax up to 12 months in advance, which will ultimately help with all your cash flow planning. And as we've learned, and I think we've been saying this since COVID, cash is king. So helping you to plan what tax is coming is only going to benefit you. So what we're also, if we do it if we do tax planning before 30 June, we can work out ways to minimise your tax, not avoid tax, but minimise tax. And there are various strategies that you may need to implement well before 30 June to take advantage of any tax planning opportunities. And the benefit of doing tax planning early is that we can put those tax strategies into place as soon as possible. Many people don't realise, but with the receipt of JobKeeper payments, you may actually find that you have profits this year. So even though your business is maybe in a loss, the receipt of JobKeeper payments may take it into a tax-paying situation, which you should be aware of and you need to be aware of, again, for cash flow purposes. Tax planning also helps us determine profits from trusts. And you'll all be receiving emails soon about how important it is to do trust distribution resolutions prior to 30 June. And this exercise is exactly what is needed to enable us to do and complete those trust distribution resolutions. And we'll outline why that is so important later on in the webinar.
Great, thank you, Leishan. So getting into some personal tax strategies. So the first one is all about superannuation. So as we all know, there is a $25,000 cap for everyone. This means that you can claim a tax-deductible super contribution for up to $25,000 for any individual that's under the age of 75. For any individual that's over the age of 67, they also need to pass what's called a work test. So the people that would benefit most from a strategy of contributing additional deductible amounts into super are those who earn about $45,000 and above, because this is where the marginal tax rate kicks in to 34.5%. So to save tax, consider making that deductible super contribution before 30 June 2021. The next one is carry forward contributions. Oops. I wanted to change this page, not that page. So from 1 July 2018, people can make carry forward concessional super contributions if they have a super balance of less than $500,000. So these carry forward contributions allow super fund members to use any of their unused concessional contribution caps on a rolling basis for 5 years. So what does this mean? This means if you don't use your full amount of the concessional contribution cap of $25,000 in either the 2019, 2020 or 2021 years, you can carry forward that unused amount and take advantage of it up to 5 years later. Yep, that's all I'll say, I think. So I want to keep this one shorter and get my ideas and stuff. The last strategy, and it's not the last, but it's the last key strategy. There are some other super strategies as well. This is government co-contributions. So this is a really good strategy if you're an individual on a lower income tax rate and you earn at least 10% of your income from employment or from carrying on a business. So under this strategy, you can make a contribution, a non-concessional contribution to super. A non-concessional contribution is one that is not tax deductible, and you may be eligible for a government co-contribution of up to $500.
If you're on a lower income and earn at least 10% of your income from employment, is it or you are carrying on a business? Because otherwise it's 10%. When you say it, it sounds like 10% employment income or 10% business income.
Oh,
so
okay.
That's the way it sounds when you say it. Sorry.
Or you are. Carry on. Yeah, that makes sense.
Sorry,
sure.
Yeah.
Or, and then I'll pause. You are.
Yeah.
Sure.
Perfect.
I get it. So in 2021, the maximum co-contribution is available if you contribute, say, $1,000 and you earn $39,837 or less. The next strategy for personal tax is if you have a rental property, make sure that you have a property depreciation or quantity surveyor report. These are really good because they allow you to claim depreciation, which is non-cash deductions, for capital items.
We like those.
Yeah, we like those a lot because you don't actually have to spend the money on capital items within the property or on the property itself. So the cost of this kind of report is usually about $500-600.
$600, yeah.
And it's tax deductible as well. The next strategy for personal tax is motor vehicle logbooks. So as an individual, there are two key ways that you can claim work-related or income-producing related motor vehicle expenses, either using the cents per kilometre method or the logbook method. If you use your motor vehicle for business purposes a lot, I think about that.
So you have to be able to support it, right?
Yeah, you have to be able to support it. But what I'm trying to say is if you do use your motor vehicle quite often for income producing purposes, then you'll often get a much larger deduction under the logbook method. What, have I got something there?
No, I'm
under the logbook. You don't listen to me.
Yeah, no, I'm listening to you.
Under the logbook method, it's a pain because you have to keep it for 12 weeks. But once you keep it for 12 weeks and you establish a business percentage or income producing percentage of your logbook, you can then claim that percentage of everything to do with that motor vehicle, from fuel to rego to repairs and maintenance, new tyres, etc., etc.
The only downside of doing that, other than doing the freaking logbook, which is a pain in the bum, is when you come to sell it, it's a taxable item.
It is. So you need to do an adjustment. That's true.
So that's just the only, I mean, it's not a massive thing, but because cars don't really appreciate in value, but it's still going to be put in your tax return when you sell it.
That's true. That is so true. So the fourth strategy for personal tax is prepaying expenses such as rental interest. So you can prepay up to 12 months of interest expense, for example, on an investment property loan, and you can claim a tax deduction for it in this year. Other expenses that you might be able to prepay in this financial year and get a tax deduction for them include things like memberships and subscriptions. Oh, and lastly, or did you want to say something?
No, leave my slide alone.
I know, I keep And lastly, the last strategy is work-related expenses. So don't forget to keep receipts for work-related expenses such as uniforms or training courses or learning materials, as they may be tax deductible. So as an individual, if you don't keep receipts, you can only claim a maximum of $300 in your tax return, which is not a lot. So make sure you keep receipts. And lastly, one thing I wanted to note was just remember that in order to get a tax deduction, you generally have to spend money. So don't just spend money for the sake of getting a tax deduction.
So true.
Yeah. And the other common misconception is that if you spend money, you don't get a tax deduction for the whole amount that you spend. You only get a deduction for your marginal tax rate. So for example, if you spend $100 on a work-related item and your marginal tax rate is at 39%, that means you only effectively get $39 tax deduction when you spend $100.
Which means the rest is out of pocket.
Which means the rest is out of pocket. That's right. Okay, over to you, Alicia.
My slide. So the next section is all about business strategies. But to access a lot of these strategies, you have to be a small business entity. And due to the ATO's recent but not so recent changes, a small business entity is any entity where their turnover is under $10 million and an entity that is operating a business. So not an entity that's an investment business or one that's renting properties, for example, or renting a single property. There's an argument if there's multiple properties. But anyway, so that's so you just got to fit into that category. And then the other benefit is if you're a base rate entity, then you won't be taxed at 30%, you'll be taxed at 26%. But this is where for businesses where their turnover is less than 50 million and their passive income, interest, rent, dividends, is under 80%. So if you meet those two situations, then The rest of the webinar will apply, and you'll also get access to the 26% tax rate. Over to you.
Thank you. Okay, so this is a strategy that we get asked about a lot. This is all about the temporary full expensing for asset purchases, or a lot of people just refer it to the instant asset write-off. So this strategy applies for new and used assets for all entities with an aggregated turnover of less than 50 million. If your aggregated turnover is above 50 million, but no less than $5 billion, then you can only use the instant asset write-off for new assets only. These measures apply until the 30th of June 2022. So it's important to ensure that if you want to get access to this concession this year, you need to make sure that you have bought the asset and have it installed and ready for use by 30 June 2021. The other part of this is for all small businesses that have small business pools, they can be fully expensed and written off. Another thing that we get a lot of people asking us, can we claim our cars and get an instant asset write-off for our motor vehicles that we claim under our businesses? So our answer to that is it depends on the cost of the motor vehicle. So if your car costs more than $59,136 for the 2021 financial year, you can only claim a deduction for your motor vehicle up to that car limit. And also with all of the instant asset write-off, you can only claim up. You can only claim. I know you want to jump in. Yeah. You can only claim the business portion of those assets.
I was going to say, I was going to say, agree with you.
Oh, yeah. Yeah. The other important thing to remember with the
stat method thing?
What happens with the stat method?
You've got a car.
Well, that's, so I have a feeling the instant asset write-off is for tax, but for FBT you have the deemed depreciation. So different kind of different type of depreciation.
For tax, what's the business usage?
Under the stat method, we claim the whole lot.
You would? Okay.
Under stat, yeah. Yeah, we claim 100% of everything. No, but I don't think that has changed at all. Because under stat, you claim everything, and then you do the FBT reimbursement under the stat method, but you claim everything for tax purposes. So I don't think that would change.
So it's saying that you've got like a 20% business usage is what's confusing me.
Yeah. Oh, okay, yeah. It adds it back every year. So you get to write, so the first year you're going to have a loss, but in the other years, because you don't have depreciation offset, tax depreciation offset, you're going to profit. Yeah. But I don't think we'll go into that.
No. I'm just saying in my
But yeah. So another important thing to remember with the temporary full expensing of assets is that when you sell the asset in the future, the full amount of the proceeds will be treated as assessable income in the year that you sell. The next strategy under assets for business is similar to what I mentioned before for under the personal tax strategies, is if your business owns an investment property or commercial premises that you use in your business, it is really important that you get a quantity surveyor report. It's optional, but we highly recommend it for all our clients because you get access to those non-cash depreciation deductions and building allowance deductions if the building isn't too old. The third one is around repairs and maintenance for assets. So if you have repairs and maintenance that need to be made, it would be a good idea to attend to those before 30 June so that you can get a tax deduction for this year. I'll put this in. So this is a, So this isn't in your workbook, but Leisha and I had to have a laugh.
Yeah.
So we took this photo on our way home on a rainy Friday afternoon last week and thought it was quite fitting for this slide because clearly this person what tax has a tax plan, well, or wants to take advantage of the instant asset write-off. So as accountants, here are some of the things that were going through our minds. I wonder if this person is claiming the instant asset write-off. Is that even a car? So with cars and the car limit, that's a specified term within the Tax Act. So if it is a car, then they can only claim it up to the car limit of the $59,000, which I mentioned before. And I wonder if that car is being used for business purposes or not. So these are some of the things that were going through our minds. Over to
Whilst we're not illegally trying to take a photo, but anyway.
I was the passenger.
Yeah, I was driving.
Disclaimer, I was the passenger in the car and I was taking the photo.
So now we're going to talk a bit about super. So Teresa mentioned super contributions at an individual level, and it's really not much different from a business perspective. So the concessional contribution cap is still $25,000. So that includes your superannuation guarantee, as well as any other deductions that you might make along the way or choose to make in excess of that. Do not go over this limit, otherwise you'll end up paying more tax. Should I say that?
I think it's pretty much it. I guess another part to mention with these deductible super contribution deletion is one of the things we do as tax planning is we work out whether it's best to take the deductible super contribution in your individual name or through your business.
Yeah.
So we look at a couple of different scenarios so that you get the best outcome.
I was just going to say, we also look, that's really at the individual level, the rolling. Also, when you pay as a business, when you pay your employee superannuation, you normally pay it by the 28th day after the end of every quarter. Well, if you pay your June superannuation for your employees before 30 June instead of the 28th of July, you will get that as a tax deduction in your 2021 year. Now, obviously, you need the cash to be able to do that. If you don't, one, you could think about paying 2 months' worth instead of 3. You just need to make sure that quarter's superannuation is paid by the 28th of July in order to get a tax deduction for it. In terms of timing of superannuation, if you pay superannuation through a superannuation clearinghouse, you should get that paid by the 24th of June in order for it to clear before the 30th of June.
Yeah. And I think it's really important also to mention, because it comes up time and again, just to highlight the point that you need to make sure that you pay super by the due date in order to get the tax deduction. So the law is really black and white on that, isn't it? There is no wiggle room.
So even if it's a day late, not deductible.
Yeah.
And then you have to lodge those superannuation surcharge, guarantee charge.
SG charge,
SG
forms,
forms.
Okay, so the next business tax strategy is all around FBT exempt tools of trade. So what we mean by these, so what are some work-related items that are exempt from FBT or fringe benefits tax? These things include portable electronic devices such as mobile phones or laptops. It can include computer software, protective clothing, etc., etc. So what you can do with all of these, but having said that, because they're exempt from fringe benefits tax, they can be effectively salary packaged for employees. If it's structured correctly, then what can actually happen is you as an employer will be entitled to a tax deduction for the reimbursement payment to the employee for the equipment cost. You as the employer can claim a GST input tax credit, and the employee's salary package, however, will only be reduced by the GST exclusive cost of the item purchased. If you want to undertake these kind of strategies, then this needs to happen. Those items need to be purchased before the 30th of June 2021.
And that's really handy, especially notebooks, for example, and mobile phones. Again, it's only the business portion, but where people are working more from home and they want to have their home set up.
Yeah, absolutely.
Yeah.
Yeah.
So Division 7A is the next cab off the rank. So this is where, in general, where you have a company and as a shareholder or associate or a director, you pull money out of the company. It's not your money, it is the company's money, and the ATO say that you have borrowed that money. And so what they want, the whole premise of Division 7A is that you then put that amount under a loan agreement, and you have to ensure that appropriate principal and interest repayments are made or pay back the amount in full. Although if you don't do the above, then the ATO will deem it as an unfranked deemed dividend, which is fairly nasty. And this is on the basis that companies are concessionally taxed, i.e. they have that 26% for this year, whereas individuals are taxed at higher rates. So they want to try and even that out a little bit. But what we need to do prior to 30 June 2021 in this case is make sure that all your P&I repayments have been made where necessary.
Yeah. Yeah. Okay. So other business tax strategies. So this slide we go through a few more different types of strategies for businesses. The first one is prepayments for small businesses. So as Leisha mentioned before, if you're deemed to be a small business entity, you do get some additional tax concessions for your business. And one of these is around prepayments. So generally, if you make a prepayment for an expense, you can only claim a tax deduction for the period of service. And if that period of service spans a financial year, it means you can only claim a portion of it this year and a portion for it next year. However, if you are a small business entity, you can claim the whole cost of that prepayment up front. The next one is year-end stock take. So this is really, really important. If applicable, it's really important that if you have stock in your business, that you do a stock take on 30 June 2021. When you're reviewing your list, write off any obsolete and worthless stock so that you get a tax deduction for it in this year. Again, small business entities do have a concession, and they've got simplified trading stock rules. So if you are a small business and you don't think that your inventory has changed by greater than $5,000 in terms of value, you actually don't have to take a stock take. However, best practice, we generally recommend most of our clients do a stock take at the end of the year.
Stock is money.
Yeah, stock is money, exactly. And what Leisha means by that, when it comes to stock, you only actually get a deduction for the stock at the time that you sell it, not at the time that you buy it, which is why around this time of the year, you'll see so many businesses out there doing stock take sales. It's because they're trying to reduce their stock so they can get a deduction for the stock in this financial year. The next strategy is all about writing off bad debts. So now's a really good time of year to review your aged receivables or trade debtor lists and work out if there are any bad debts where you have tried to collect them and you've deemed them no longer collectible. You can write them off as bad. In order to be able to write them off as bad and get a tax deduction for it for tax purposes, you've got to make sure it is actually a bad debt. That means you've got to evidence that you have actually chased that debt to a point where it's no longer practical or commercial to chase that debt, and you actually have to write it off in the books by 30 June 2021. All our clients would generally also do a minute to document that process. The fourth strategy is bearing down tax installments. So this is a really good strategy around cash flow management. So if your income has changed or decreased since you lodged your last tax return, chances are that your quarterly income tax instalments that you pay on your BAS are too high. So now's a very good time when we're looking at estimates of income and tax for the financial year to vary down instalments where appropriate so that it can help manage your cash flow moving forward. Over to you, Lisha.
Cool. So when I talked about why we do tax planning, this section here is what I was referring to when we were talking about the trust distribution minutes. So if a trustee or if a trust fails to make a resolution to distribute its income before 30 June, then the trustee, whether it be an individual or a company, will be assessed by the ATO at the highest marginal rate of 47%. Yuck.
It is, yeah.
So this is why, and so we've had tax planning emails come out which have discussed trust distribution resolutions. We will have trust distribution emails coming out reminding every trust that you need to do your minutes before 30 June 2021. And we need time to confirm for you the estimated trust income for the year. We need to review your trust deed and consider the most tax effective distribution of income so that we can complete the minutes for you. Now we're going to go through a funky
well, it's not funky, it's very legitimate. Very legitimate and common strategy.
The slide is funky because Teresa did slide. And this is a scenario where so we do this a lot with family groups. So we use bucket companies. And so very often we'll have mum and dad. We would never split it 50-50, but just in this example, say we split the 250K profit, we split it 50-50, the tax on 120.
50-50.
Well, mum might be earning income, or dad might be earning income.
Or maybe they're both not earning any income.
Anyway. We would rarely split it 50-50, but sometimes we will. But anyway, tax.
I split 50-50 a lot because I've got a lot of retirees.
Oh, okay. Yes, I do.
Yeah, that's what I was asking. I would never ask you like this in front of an audience.
Yeah.
No, I never do it. A lot.
Yeah. Okay.
It's like, you equalise pensions and super funds, same sort of thing. Yeah.
Okay. So in this scenario, income has been split 50-50 between mum and dad, and they've got tax to pay on that income of say 34 grand each. So total tax of 68,000. Now we introduce a bucket company. So in this scenario, 250K profit has been split 90K to dad, 90K to mum, and 70K to this bucket company. So the tax is now reduced from 34K to 20 for mum and dad, and then 18K for the company as its tax rate is 26. 27.
This is the GPS number. Bless you. Yeah, 26%.
Okay, 26% is 18.2K.
Yeah, 26%.
So the total tax has gone from 67.6K. I'll actually stick to your points. 67.6K to 59K, which is a total saving of $8,600. Now that's for year one. So this will be year in, year out. So it's a very effective tax minimisation strategy. It does require some management going forward because you do start to have a Div 7A issue here.
If you get the money out of the bucket company.
But it is all manageable.
Thank you, Lisha. So Lish and I have taken you through a number of different strategies for year-end tax planning. So we've taken you through probably some of the most common and key tax strategies.
There are some others, but yeah.
There are many more. And at the end of the day, it depends on your circumstances and your business. So some of the things that we can assist with in terms of tax planning, I tried and tried and tried. It was so full. Oh, can you sense my frustration?
Yes.
It took about half an hour. Because I was all cut off on the side.
Oh, yes. This is the one. Yes.
I don't know what she's done. Even mine's still cut. I don't know what she's done. And I can't bring it across. And then I tried deleting it all, rewriting it all.
So to me,
she doesn't know PowerPoint.
This shouldn't have been that difficult.
No.
And yeah. Did you get on the phone with her at all?
No.
I did.
No, I didn't.
Okay, see this slide? That needs to go there.
Yeah, no, I didn't.
For all of mine, I got on the phone for her and just went.
Yeah, I just feel like she doesn't know PowerPoint.
She doesn't, but I think she also doesn't understand.
Yeah, no, I just went in there and fixed it myself. Yeah. It was easy, but I could not bring that across. Yeah. So, done is better than perfect, but I agree. Because then it also goes smaller, because on my other slides, if I put sub-bullet points in, the writing's slightly smaller, so it's like the heading with the sub-bullet points. I don't know what she's done. What kind of formatting and why it's different, because all my slides were the black and white ones. It should have been so simple, but I don't know what she's done anyway. So we have a range of tax planning services that we provide or that we offer to our clients. The first one is the full tax planning service. So some of the things, it's definitely, we go below the surface. So some of the things it includes is an estimation of the 2021 tax profits for your entire group. What we then do is we consider the best strategies for the legal reduction and minimisation of tax across the group. We then prepare a pretty detailed tax planning report, which goes through all the strategies, how much it'll cost you in cash and how much tax you will save. And then we will either have a meeting or a phone call or Zoom discussion with you to take you through that report so that you can start implementing the strategies before 30 June. The next service that we provide, and Leishan's mentioned this plenty of times, is that we can assist with your trust distribution resolutions and dividend minutes. So as Leishan mentioned, it's really important that these are done before 30 June. If they're not done before 30 June, the ATO deem that no one is entitled to that income and they will tax it at the highest marginal rate. The third thing that we offer to our clients is all around cash flow planning for your tax liabilities. So what we can actually do is help plan out the amount and the timing of tax payments over the next 12 to 18 months so that you can implement that into your cash flow planning so you can see exactly where you stand. Feel free to contact us if you'd like to know more about it. Questions? So this is yours.
Okay, so there's a question here that says, if I bought a piece of equipment, you're going to do that one? Oh, okay. If I bought a piece of equipment for $140,000 today, is it deductible?
I think then I answered it and then you answered the poking machine example.
Oh, yeah,
and then
that's
after that one and you answered it.
Yeah.
So I'll go LS, TA, and then answer LS.
So yeah,
is it deductible?
Yeah.
Okay, great question. So in order to ensure that that piece of equipment is deductible, in this financial year, there are a couple of things that you have to ensure are in place. So the first one is that that piece of equipment needs to be used or installed ready for use by 30 June 2021. Don't forget that if you then sell that piece of equipment in the future, whatever price you get for the selling of that piece of equipment will be fully accessible in that income year. The other thing is you only get a deduction for the business portion of that amount. So if you bought a piece of equipment for $140,000 and used it 100% for business, you would get the full deduction for the $140,000. If you used it for less, then you only get a proportionate deduction for that vehicle. I wrote trucks, but I can't remember why. Anyway.
Okay, so I've got a war story on that one. I used to do the books for a pub, and it had pokie machines.
Which are quite expensive pieces of equipment.
Massive. It was actually like $80 million worth of pokie machines. And this was in addition to the ones that they already had. So what they did was they'd brought them on shore, they'd put them into a warehouse because they weren't ready to put them on site just yet. And so we only depreciated those that were on site because they were ready and available for use, whereas the ones that were off site weren't ready for use. So they did no deduction for $80 million worth.
That's insane.
Yeah. Yeah. But that's the way the rules work.
Yep. Okay. So hopefully that answers that question. Okay, another question we've got here, which is actually a really good one. Should I be paying myself wages out of my company, or should I be paying myself a dividend?
Yeah, that's actually a really interesting question, because the answer is it depends.
Mm-hmm.
So, for example, if you're already getting a wage, we may think of doing a dividend. If you weren't, it depends on where it would take you in your marginal tax rate. And if you weren't getting a wage, there's this really funky thing, because a company has paid tax already. So if the company it goes into a franking account, and if we have available credits in our franking account, we can actually get you a refund in some cases when it comes out into your name as a dividend, as a fully franked dividend. So we have that. This is where we would run different scenarios to work out the best tax strategy for you.
Dividends are also used out of companies to help make minimum principal and interest repayments under Division 7A, which is what you mentioned in your earlier slide. Yep. Great.
No more questions.
I think that's all the questions. Okay, well, thank you, everyone. We're finishing a little bit early today. Thanks to everybody for making the time to join our webinar. We hope you found it informative and useful. After this webinar, there is a brief exit survey. We would really appreciate your feedback and ideas for any topics you'd like to see in the future. We hope we've given you plenty of ideas to think about in your business. And if you have any questions, please feel free to reach out to us and our friendly team. Thanks, everyone. Bye.
See you. Adios, amigo.
It's about 45 minutes.
Yeah.
That's all right.
That's perfect.
We now have half an hour break. Oh, I'm nervous. I'm really a bit nervous. Start. I just get nervous and then I start reading.
Oh, question.
I never used to be.
How beneficial is preparing a is there always tax
benefits? That's a good one.
Because we just banged on about it being a pain in the ass.
That's a good one.
Yeah.
I like that one. Let's put that in.
How beneficial is preparing a motor vehicle logbook? Is there always tax benefits?
It's a good one. It's actually a really good one.
Yeah.
Good, Chris. Awesome.
Nice. What else? High summer. Oh no, high nation.
Oh, okay. I think that was the only one.
We were advised by PAYG images.
That's a good one. I like that. Nice. Done. Oh my God.
It
takes up a lot of time.
It takes it.
And
I don't think I slept the night before the last one.
This one is hard for me because I have to do it from scratch, including the emails, the exit survey questions. So much work involved in it. So there is benefit to the gap, but I feel like looking through the gap ones will come to a stop at some stage because there's only so many business recovery.
Supposed to be adding 1 or 2 a month, and I don't see that happening.
I haven't seen that happening at all.
I'm going to send them an email saying you promised us that there'd be 1 or 2 more.
Well, I feel that we will come to an end of that. We'll probably stop. I reckon we do with the gap. If we don't see that happening regularly, we just stop the subscription after the year. Was it 18 months or a year?
A year.
Okay. Because we've got the monthly coaching and the, because we want to keep seeing value because we can do that ourselves now, really.
But we just have to take, because I use a lot of the stuff. Like I use the business planning one, I use the monthly coaching one.
Well, I'm going to use the business planning one. I've used the minutes. They're just great ideas, but it's going to get to a point where if they don't keep adding stuff, we're not going to get the return on investment we want for the $600 odd a month.
Yeah.
But it is good. It is. I mean, it is good because remember we weren't sure because we weren't using it, but it's actually
now that we are.
It's given us a process to run really professional webinars. So even though, we did the ones that from there and then we did this one ourselves, followed the same process. It's given us a really good process. So we've got this, it makes it look professional, doesn't it? It's really, really good. See, I like that. It's white space.
So this one's good. I like that one too.
Yeah, me too. I want more like that. All this messy shit.
Yeah, I don't want that.
No.
That's the same.
But it's all not the same. It should be the same size. And there's just lots of little things that just make it better. But I didn't have time to deal with that.
It's okay.
But see that one indent, and I don't know if you noticed, I added more bullet points to my asset one because it just had 1, 2, 3. See, I added it in there, and I was able to indent it.
But you couldn't do the other one.
Couldn't do it with the other one, which says to me she's mucking around with the formatting somehow. But anyway,
because these numbers are really big. Only when you're looking at it closely, you can see, but. We're going to return some phone calls.
Yep, I'm going to come back 10 minutes beforehand. Yeah, 20 minutes. Okay. I'll just smash it out. Then we go get a latte.
Yeah. Hey. Good. How are you? Good. I saw your emails. So what I think is that you should say David's review should be charged to the group because it's a second opinion on Brent's suggestion, and given David's background, you believe this is prudent. And then my fee should go to you because they're more for your entity. Okay. Yes. Yes. I sort of got that. I got the way they didn't answer that question over there.
You know the pros now.
ask questions. And I'll repeat saying it will pay my money now. That's a good one. No, I haven't seen my email. I was in a course yesterday and
My question is
are all the questions coming through?
They were all through. They all came. Yeah, everyone put in questions. Oh, so good.
there might be two people.
I'm doing it to my children. I'm very I actually want to make it on to pay forward. I told them, no, it's not that one. And we saw that one. You gave it away. You gave it away. That's not you already. I got that one on my screen.
Oh, good. No, you know why? Because I replied, maybe we messaged everyone more. Everyone else replied.
I only got yours on my screen. I haven't seen it.
Maybe they're probably also ready to take it to reply. Because I put it in the wrong section. I didn't reply. I made my own. Yeah. And the notification doesn't go to.
I love it. Well, interesting. Actually, I think it's something questions around the webinar. If I spend $1,000, will I get $1,000 giveaway?
Yeah.
Only one I got. That was just it. Yeah. Yay!
With the HQ, this contract. The release
I don't need to just say, not the provider, right? We can take her like the other she's red. Thank you. Feedback from Michael, that was just no.
It's hard to read. I don't know what I can. Yeah.
Why is there no income when there was lunch? Why do we have time? Oh, thank goodness. Thank you so much for that.
Doesn't make sense.
Oh, cool. Thank you so much for that. Thank you. Okay, bye. Now that we've had that, we can get right.
Yeah. I would like to.
That would roll down. Please roll down their response.
For that. I'm on board. I understand.
Yes. Then I think if she doesn't perform it, good, we do. Four. Nine. We'll have to arrive. Yeah. Sure. Yes, 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 yes. I do, yes. Oh, that's awesome. Yeah. Not sweet, maybe faster.
Let me check. Hang on. First, I think. First, yeah, yeah. No, that suits. Because we were always we would never have done so before. But if there's that separation from red and blue, it's not. Yeah, yeah. Thank you. Thank you. Okay. No.
Oh, awesome. You think we can get them out?
Oh, yeah. Yeah. And that reduces those things. Yeah, it's just one of those things that's restricted to that concept. You know, I reckon the way it works, because otherwise we'd be after a full schedule. My colleagues would taxes out. That's not the image. So simply everything works out as normal and everything comes in from moving and so it's got to be audited. Yeah, it's got, yeah, full thing's got to go through. Yeah, but so you can't claim anything until certificate. And then now we'll probably
keep saying it's losses.
Yeah.
Losses.
Right.
Awesome.
Yeah.
We try and get that out.
Oh yeah, I'm doing May 1st.
Bills for bands and tax planning. What's do you want to say?
Yeah.
Yeah. Is it going to be a bill to the collective side or is it just
No,
it's just that? Yeah, on that side. Okay. Yeah. I've got what I think on both. So
Yeah.
That's right.
No, collective and fail, collective and bad.
Yeah, so I'll be back $900. Yeah.
No photo bombing or Zoom bombing. Yes, this one gets on it, cuts in, and he's laughing and giggling. And we go, Chris, shut up! Get off! And we're trying to get him off, and then we're going, oh, he's on our Zoom. It was like panic station. It was funny though.
Oh, right, yeah. So you got an email from PAYG. I'll send you a fresh email. No, I'm glad that you're. So I just think if you want fresh email, and that's what. I think it's a good email. Thank you for coming with that.
Every now and then I'll take them, but yeah, more so fast now.
Okay.
Okay. Oh yeah, 1237. Okay.
So I'm going to start this.
Coming in. I'm going to bring my brain and be distracting. Oh no, we need it, don't we? Time thing. try and keep volume down if you can, so it doesn't come through the.
We're on. We're just waiting for everyone to join us, so I'll just put us on mute while we babble to one another.
Wait for 2 minutes.
Yeah,
until it's 12:30.
See you soon.
Hello, everybody, and welcome to our third webinar in our series of webinars. Thank you all for making the time to join us today. This webinar is really, really crucial and at a really good time of year because it's all about tax planning as we get into 30 June 2021. So Leisha and I are going to take you through a number of strategies on how to reduce your tax, grow your wealth, and increase certainty when it comes to tax and tax planning for your business. So let's get into it. Okay, so your webinar hosts, hopefully we're familiar to many of you already now. So I'm Teresa Allery. I'm one of the directors at Element Business and Accounting Solutions, and I'm joined by my business partner, Leisha Smaller, who is also a director at Element Business and Accounting Solutions. For those of you who are not familiar with the Zoom webinar environment, and hopefully many of us are now, especially with COVID, we've all moved to Zoom now. So this webinar is run through Zoom. Some of the Zoom settings that you may need to look at is the audio settings over here. So hopefully you can all hear us really, really well. Then we've also got the chat and the raise hand functions. Now we don't really use these functions very much. We may later on as we get better at it.
Only because it requires multitasking and we're just not
we're not there yet. But with practice, we will get there. So the one that you might find useful is the Q&A section over here. So if you have any questions throughout the webinar, feel free to pop your questions into the Q&A section there. And if we have time at the end, we will answer some of the questions. You can also click to leave the meeting if you need to leave. And you can just rejoin using your registration link. So over to you, Leisha, with the thought of the day.
Cool. So the thought of the day that we thought related really well to what we're speaking to you about is effective performance is preceded by painstaking preparation. Now, this is a quote by Brian Tracy, and many of you will know he wrote that book called Eat That Frog, which is all about fighting off procrastination. No one likes doing their tax. No one likes doing their tax planning. So what we fundamentally believe that by doing tax planning, what you put in you'll get out, because we do a lot of profit forecasting, and so it avoids all surprises. There's another quote by Brian Tracy, which is, successful people are simply those with successful habits. And again, we think that effective and proactive tax planning is an example of a successful habit for a successful business. So take it away, Teresa.
Thank you, Leishan. So the agenda for today. So this is what we're going to be talking about on our webinar today. The first thing we're going to start off with before we actually get into the strategies is, why is tax planning so important? So we'll take you through why tax planning is important and why it's important to start it now. The next section of the webinar, and this is a smaller section, we'll be taking you through some key strategies for personal tax. Then I guess we get into the crux or the bulk of our webinar, which is running you through some key strategies for business tax. We're then going to do a deep dive into two key main issues. The first one is all about the importance of trust distribution resolutions. And the second one is how you can minimise tax using bucket companies in your family group. And we'll take you through an awesome diagram later on. It's awesome because I did it. Then we're going to talk about the way forward. So what are some of the services that we provide, and what are some of the things that you can do for the way forward between now and 30 June? And then lastly, if we have some time, we'll go through some questions that you may have asked throughout the webinar. Before we move on, and I kept forgetting this in the practice sessions, but we are professionals, so we do have a disclaimer for you. Please just remember, the information in this webinar is for educational purposes. It is not a substitute for one-on-one tailored advice to your circumstances. We're also going to be talking about a number of superannuation strategies. So it's important to note again that those are educational in nature. It is not financial advice. It is for tax planning purposes. If you would like to work with us one-on-one for some personalised strategies, please feel free to reach out. Over to you, Leishan.
Awesome. So why is tax planning so important? So I guess the number one reason is that you get to understand how much tax you need to pay up to 12 months in advance of actually having to pay it out. So you can factor it into your budgets and your cash flows. So none of this is a surprise. By doing tax planning, we can identify opportunities to minimise legally, not avoid, your tax, and we can help you implement strategies prior to 30 June so that what you are planning or what you're going to pay in tax has actually been strategically thought about. And many of the strategies we'll talk about today, where they come to money, it all needs to be spent prior to 30 June. Also, a lot of businesses may or may not realise that JobKeeper payments are actually taxable. So your normal operating business might be in a loss, but then if you've got all these JobKeeper payments coming in, then that might take you into a profit and you'll have more tax to pay than you may have thought you would. So that gives us an opportunity to let you know what that will be. Now, number 4, which we will go into a lot more detail towards the end of this webinar, is that we'll help you determine profits from trusts so that we can actually do the trust distribution resolutions prior to 30 June 2021 in this case, which is so, so important. And leading on from that, it'll also help us plan some dividend payments if that applies to you, all of which the ATO really want done prior to year end.
It's a big focus now for the ATO, isn't it?
Okay, Teresa. Yeah, there you go.
Okay, so let's get into some personal tax strategies. So there's 5 key strategies which we thought we'd highlight for today. There, of course, is many more, but these are some common strategies. These are the major ones and some common ones that you can implement from a personal tax perspective. So the first ones are all around superannuation. The first one being the $25,000 concessional cap. So every taxpayer has access to this deductible superannuation cap, well, for anyone under the age of 65. If you're over 67, then there's an additional work requirement that you need to meet. So what this basically means is you can contribute up to $25,000 into your superannuation fund, and you can nominate to get a tax deduction for it in your personal tax return. So this strategy benefits mainly those people who earn at least more than $45,000, because that takes you into the marginal tax rate of about 34.5%, which is when this would be of most benefit. The next superannuation strategy that I wanted to raise was the carry forward contributions. So this came in from 1 July 2018 onwards. And what this strategy is, so people can make carry forward super contributions if they have a total superannuation balance of less than $500,000. So the carry forward super contributions allow members to use any of their unused concessional contribution caps on a rolling 5-year basis. So what does that mean? Let's think about it. So this means that if you don't use your full $25,000 superannuation cap in any of the 2019, 2020 or 2021 financial years, then you can carry forward the unused cap and use it within 5 years to claim additional tax deductions. It's really cool. So this would be really good if, for example, you have made a large capital gain in a particular year. You can bring those carry forward caps forward and get a larger deduction whilst boosting up your superannuation. The third strategy around superannuation for personal tax is a good one if you are on a lower income rate and you earn at least 10% of your income from employment, or if you are carrying on a business, then you can make a non-concessional contribution into super. A non-concessional contribution is one where you don't get a tax deduction. So you can put up to $1,000 into your super fund, and the government will co-contribute a maximum of $500 into your super as well, which means you basically get $1,500 into your super fund. So in order to get that maximum, your taxable income needs to be below $39,837.
Doesn't apply to many, but on the odd occasion, it does come in
it's
handy.
a really,
it is a
absolutely. It's free money from the government, and it boosts.
How often do they give that out?
Well, lots lately, but it's true. It's coming to an end. It's coming to an end. So the next strategy for personal tax is if you have a rental or an investment property or a commercial property, then it's a really good idea to get a rental property depreciation or quantity surveyor report. And the reason for that is the quantity surveyor report gives you access to non-cash depreciation and capital allowance deductions, which is depreciation on buildings if they were built after 1985. Really good deductions in your tax return. The report costs about $500-600. It's also tax deductible, and it is well worth getting for the tax deductions you get throughout the life of your investment property, I guess. The third strategy for personal tax is all about motor vehicle logbooks. So these are painful. I've had many clients call me up and go, why am I doing this? And we always say, well, you can often get a really good tax deduction. So as an individual, if you use your motor vehicle in your income producing activities, whether it be salary and wages or running your business, then there's basically 2 ways you can claim motor vehicle deductions. So you can claim motor vehicle deductions using the cents per kilometre method, which gives you about a $3,400 capped deduction if you max it out, or you can claim depreciation under the logbook method. So if you're using your motor vehicle quite a lot for business, then the logbook method might be more beneficial to you, because what it does, it establishes a business use percentage for your motor vehicle, and then you can apply that percentage across all your motor vehicle deductions, from fuel to RACQ to insurance, repairs and maintenance, etc., etc. There is a fair bit of, I guess, record keeping involved, but well worth the deductions at the end of the day. And then that motor vehicle logbook, you only have to keep it for 12 weeks. And it will last you for that particular vehicle. Only it's painful, but in the grand scheme of things, it will then last you 5 years unless you substantially change the use of your motor vehicle.
So just on that, the ATO monitor all motor vehicle purchases. So this is something that they will be cracking down.
Fairly new, this has come in.
Yeah, so if you are going to use the logbook method, make sure you have a logbook.
Yeah, agree. Completely agree. Yeah. The fourth strategy is all around prepaying expenses and interest. So what we mean by this, let's say we'll go back to the rental property example. Let's say you have a rental property and you have an investment loan against that investment property. You can claim up to 12 months of prepaid interest in this financial year, but that interest has to be prepaid by 30 June in order to get that deduction. So other prepaid expenses that you can use this for, it might be property repairs, memberships and subscriptions. So really useful if you have the cash now. The last one is around work-related expenses, and it is a strategy, but it's also a reminder. And it's amazing how often people don't have invoices anymore. Keep invoices for work-related expenses without receipts. Or receipts. So without that documentation, you can only claim up to $300 in your tax return as a deduction without substantiation, which is not a lot. If you keep your receipts or tax invoices, then you can claim all your work-related expenses. That might include things such as training courses or learning materials, uniforms, tools of trade, etc., etc. One thing to remember when you're spending money to get tax deductions, well, I guess one important thing to remember is that often, apart from the rental property depreciation report, which we spoke about, you generally have to spend money in order to get a tax deduction. So your cash flow position is quite important when we look at tax planning strategies. Another important thing to note, and it is a common misconception, is if you spend $100 on a work-related expense, for example, you do not get a tax deduction for the full $100. You only get a tax deduction up to your marginal rate of tax. So let's say your marginal rate of tax is 39% and you spend $100 buying a work-related book, then your effective tax deduction is $39, being 39% of the $100. The rest you have to cash flow.
Yeah. I get asked that a lot.
Yeah. It's a very common misconception. Okay, over to you, Leishan.
So this is really a preamble to what Therese is going to talk to you about with business tax strategies. So to access these strategies, you generally have to be a small business entity. And a small business entity is one that has less than $10 million worth of income and, as the name suggests, is operating a business. So it can't be a business that has a rental property, but it might be a business that has several rental properties, for example, or just a normal trading business, which is really what it's aimed at. In conjunction with that, if you are a base rate entity, you are eligible for the lower tax rate. So for 2021, the tax rate is 26%. And if you are a base rate entity, that is an entity that has less than $50 million turnover and its passive income, so interest, dividends, rent, must be less than 80%. Otherwise, your company tax rate is 30%. And this will become relevant when you look at an example down the track.
Thank you, Leishan. Okay, so we're going to talk now about some business tax strategies around assets. So the big one we've been talking about a lot, and this basically came in as a response to COVID. It was firstly ignored, I guess, because people were worried about, what it meant when COVID hit. But we're seeing this being used a lot more now, aren't we? As things have settled down in the economy a little bit. It's something we're living with, I guess. So this is all about the temporary full expensing for asset purchases, or it's also known as the instant asset write-off. So the instant asset write-off is basically available for any business with turnover of less than $5 billion. And you heard me right, it's $5 billion. So that's the new asset. I know, well, it's a lot. That it pretty much would include pretty much all our clients. And I'm sure a lot of you out there as well. So if, however, your business has an aggregated turnover of less than $50 million, then you can apply this for new and used assets. Where your turnover is over $50 million, you can only temporarily fully expense assets that are new assets and not used assets. These measures extend beyond this financial year, and they will apply until 30 June 2022. So that's next financial year. For small businesses, a lot of small businesses will have small business pools. So that's where you basically aggregate all your asset purchases into one pool. So what we can do this year, we can fully expense the balance of that pool, which in some cases will produce some pretty large tax deductions for this financial year. One thing to note with the instant asset write-off or temporary full expensing, which to me sounds a bit more like it's more of a mouthful than instant asset write-off. One thing to note is, yes, you get full deductions this year, but when you go and sell that asset down the track, then the full amount of the proceeds that you receive for the sale of those assets will be assessable income in a future year when you sell. Another really common question we get asked around the instant asset write-off is, if I buy a car, can I claim the whole cost of the car in the year that I buy it?
Is that slide next?
It is. Okay. So yeah, it is. yeah. So the answer to that is, it really depends. So if the car costs less than $59,136, which is the ATO car limit, and you use that car 100% for business purposes, then the answer would be yes. However, if you have a luxury car, so let's say you go out and you buy that Lambo, and then you can Lamborghini, then you can only claim up to $59,136.
$250,000.
Yes, exactly. And you'd have a pretty horrendous fringe benefits tax issue. But putting that aside, that is the answer for motor vehicles. So the next tax strategy around assets for business is similar to what I was discussing before for personal investment properties. Same thing, if you have an investment property in a business, it might be a rental property, it might be a commercial building, then again, we recommend this to all our clients, don't we, is get a quantity surveyor or property depreciation report. Because what that report does, it will list out all the fixtures and fittings within that property, as well as assess the build cost of the building, and you'll get ongoing tax deductions for those properties. Really, really worth it.
So we have it for our office. So we obviously don't own our office, but we fitted it out.
Yes.
So we get depreciation on the fit out.
Exactly. That's a good example. Good example. The last one that I wanted to talk about was repairs and maintenance. So if you're looking to make any repairs and maintenance to your assets and you do have the cash available to do it and you want the tax deduction before 30 June, then start making arrangements for those repairs and maintenance now, because that money has to be incurred before 30 June so that you can get the tax deduction. So this is a late addition slide. This is quite, Leisha and I were laughing. So we were driving home on Friday evening, which is why it's a late addition to this slide. After practicing this webinar. So we thought it was quite funny. Full disclaimer, Leisha was driving, I was photographing. We were not driving and photographing at the same time. And this car just happened to be in front of us. I don't know if you can see the number plate there. It says what tax? I don't know if you can see that. What tax?
Accounting brands, we thought that was hilarious.
Yeah, so we thought it was funny. So we're going, I wonder whether that person is going to claim the instant asset write-off for that vehicle. And I wonder if that vehicle is a car as defined for tax purposes. And if so, I imagine it's probably worth more than the $59,000. So have they limited it to the $59,000? And I wonder if they really use it for business purposes or not. But it's displayed on there. So we thought that was a funny slide to share with you because it's relevant. It's topical. Exactly.
Anyway,
over to you, Leisha.
Okay. So from that to superannuation. So very similar, I know, but very similar to what Teresa was talking about from an individual perspective. We can also look at it as a business tax strategy. So again, you can maximise your deductible super contributions. The limit doesn't change for businesses. It's still $25,000. It includes superannuation contributions. So you be very careful that you don't exceed your cap, which is 25, like I just said, because it's pretty much horrendous. You end up with more assessable income in your own name and it's messy. So we just try and stick to that cap of 25,000. And when we go through our tax planning scenarios, we will look at superannuation being paid at a business level as well as an individual level.
To work out which is the best scenario.
So the second thing is quite easy, but again, you need to have the cash, and that is if you pay your employee superannuation before the 30th of June, you'll get a tax deduction for it this year. If you pay, because it's normally due on the 28th day after the end of each quarter, you don't have a choice as to one day later, one day before, it's the 28th day. But if you pay it beforehand, it is deductible. And so your June quarter payment is usually due in 28th July or on 28th of July. If you pay it before, you get the discount, the deduction for the whole quarter. If you don't have the cash, you might pay 1 month or 2 months, as long as the balance is paid by the 28th of July. You're okay. And if you're late, you've got to lodge those horrible superannuation surcharge documents, pay 10% for late payments. And it's, again, super, if not done properly, can be very painful.
No wiggle room.
The legislation does not allow for any wiggle room.
Very black and white. Yeah. So if you're even 1 day late with paying your super, it's not deductible. And that's just how super works. There's no discretion.
Yeah, well, it's not deductible and you have to lodge those forms.
Yes. Yep.
And you have to pay that 10% until you lodge the forms and until you pay the amount. It's unforgiving. Oh, and the other thing I had to tell you was that if you pay through a superannuation clearing account and you want to pay before the 30th of June, you need to put your payment through. There's so many dates. By the 24th of June, because it just takes that extra time to process through a clearinghouse. So just be aware of that.
And most of you probably will be using clearinghouses with single touch payroll.
Yeah, correct.
Yeah.
Yep. Sorry.
Okay.
Press the next forward button.
So the next business tax strategy slide is all about fringe benefits tax. And how you can use it to your advantage. So what I'm talking about here is fringe benefit tax exempt tools of trade. So exempt tools of trade might include such things as portable electronic devices. This might be mobile phones, laptops, notebooks, etc. It also includes computer software, protective clothing, briefcases, tools of trade, etc., etc. So what an employer can do, and Leisha, you mentioned this before in our practice webinar, it's really relevant now with COVID and more people working from home, but you can salary package these items for your employees. If it's done properly and effectively, then what it means as the employer, you may be entitled to a tax deduction for the reimbursement payment to the employee for the equipment costs. As the employer, you can claim the GST input credit associated with these tools of trade, and the employee salary package is then reduced by the GST exclusive amount or cost of the computer, notebook, etc. So it is quite effective and quite topical now, given that so many people are moving to a work from home type environment.
Yes, they want to set up their home office. They might want computers, notebooks. Yeah, I know mine does.
Yeah. Okay, next chunky topic.
So Division 7A is one of those things that we bang on about year in and year out. And it's where generally you have a company and a shareholder, director or associate pulls money out of that company. Now, many of my clients will go, but it's my money. Well, it's not. It's the company's money. So the ATO want to make sure, they basically deem that to be a loan. The company has loaned you money. And so we need to ensure, as part of your year-end tax planning, that appropriate principal and interest repayments have been made, that there is a loan agreement in place, if that's to be the case, all the money is being paid back in full. If we don't do that and you don't go through that exercise, then you have an unfranked deemed dividend situation, and that just means that a lump sum just gets lobbed into your tax return, and there's, you pay tax at marginal rates on that amount. Now, when we go through and do your tax planning, you can either make your repayments in cash, or you can make it through a dividend. And again, we weigh up those scenarios when we go through the tax planning exercise. The ATOs, we're going to be talking about the trust distribution minutes that I spoke about earlier. So the ATO are also focusing on dividends, and they'll want them pretty much decided upon by 30 June.
Perfect. Thank you, Leishan. Okay, so some other key strategies for business tax. Leishan mentioned before in her slide, small business entities. So small business entities do get certain tax concessions that other large taxpayers may not. And one of those is all around prepayments. So when you make a prepayment for a service, say, or for insurance, for example, a large business, you have to spread out the deductions for the prepayment over the service period. So if the insurance is for 12 months, then the larger business gets a deduction for the prepayment in time over the 12 months. For small businesses, however, if a small business makes a prepayment, it can get a tax deduction in full for that prepayment in the year that it is made. So that is a really good tax strategy to prepay things like insurance up front, so that you get the deduction for it. Subscriptions is another one. Yeah, is another one. The next one is all about year-end stock take. So if you're a business that has stock, it's really important that you undertake a year-end stock take on 30 June. Small businesses, again, they do have simplified trading stock rules. And those rules basically say that if you think your stock is not going to move by more than $5,000 from the year before, you actually don't then have to do a stock take. However, it's best practice if you do a stock take, and we generally recommend it. So an important thing to remember with stock. So when a business buys stock, you don't get a tax deduction when you buy the stock. You get a tax deduction when that stock is sold. So that is why so many businesses now, you'll see it all on the TV and on the ads, stock take sale, end of financial year stock take sale. And the reason for that, we love it. You get some great bargains. I was on Harbour Town on the weekend. I got some awesome bargains.
Already.
Yes, they have. Yeah. So this is businesses trying to sell their stock so that they can get a tax deduction for the stock this financial year. I guess the other general rule of thumb really is the lower your stock, the more deduction you get. The third strategy is bad debts. So now is a really good time to have a look at your trade debtors or your aged receivables and have a look at those debts that you've been having trouble collecting, or you just can't collect anymore. and work out whether you think you can write them off as a bad debt. So in order to get a tax deduction for those bad debts, the first thing is you need to have included it in your assessable income in a prior year. The second part of it is that debt actually has to be bad. So for a debt to be bad, it means that you need to have chased it to a point where it's no longer commercial or practical to chase it anymore. And the third part of it is that you actually have to write that debt off in your books on or before 30 June 2021. So what we also do for our clients is we will also do some bad debt minutes just to document that process. The fourth strategy is about varying down quarterly tax installments in your business activity statements. So this is a really effective strategy from a cash flow point of view. So if your income has changed and decreased since you lodged your last tax return, chances are you are paying higher income tax installments than what you need to be, and you don't actually get a refund of those excess installments until you lodge your tax return next year. So as part of tax planning, we will often look at the taxable income for a client and work out whether we can vary installments down now, because that means you have more cash in your pocket now rather than waiting to get that refund next year. Over to you, Lishan.
Okay, so trust distribution resolutions. I've mentioned it a couple of times now. So the ATO focus on this quite heavily, and we just want you to be aware that if your trust distributions minutes are not completed before 30 June, then the income of the trust can be assessed at 47%.
Yeah, and that's basically so the ATO say there's no beneficiary entitled to that income and therefore the trustees tax.
Yep, so this is as opposed to the beneficiary. So if we do our tax planning and we can streamline or make it, distribute income in the most tax effective way, you're going to be paying tax of 30% max, 47%. So what we need to do prior to 30 June is work with you to confirm an estimate of your trust income for the year. We review your trust deed and we consider the most tax effective distributions that we can make. And we use all the strategies that we've just talked about. Now we go on to Teresa's funky slide, because we're actually going to show you an example. And it's an example using a bucket company.
A bucket company is not a technical term, but it is a common term in the accounting world.
We'll talk about it all the time. So here we have in option 1, we have a trust with $250,000 worth of profit. And in this situation, we have dad and mum earning, we've distributed 50% each to mum and dad. Their tax on that 50% is $33,800, and the total tax, more importantly, is $67,600. Yuck. Then we introduce a bucket company. So now we distribute $90,000 to dad. He has a tax bill of $20.4K. We distribute $90,000 to mum. She's got a tax bill of the same amount. And then we distribute $70,000 to the bucket company, and it pays tax of $18,000 in round dollars. So the total tax for the group is now $59,000 instead of $68,000. That's a total saving of $8,600. That's for 1 year. So this will be year in, year out. Now, it doesn't come without its complexities. So Division 7A will apply. And you may enter into the pay-as-you-go installment regime, where you're paying tax quarterly. But that's okay. We have strategies about that too. But this is just an illustrative example of how we can streamline your distributions for a trust, because once we've decided upon that and you agree the ultimate tax amount, Then we do a minute, you sign it, it's all pre-30 June, and you're done and dusted.
Yep, all set.
There you go.
Okay, so you've heard about a number of strategies now from a personal tax perspective and also a business tax perspective. So what's the way forward? So we've listed some of the ways that we can help you with tax planning. So the first one is a full tax planning service. And what that involves is an estimation of the 2021 profits for your entire group. What we do then is we consider what the best strategies are for your business and for your group to reduce and minimise tax. We then put together a pretty detailed tax planning report, which lists all the strategies, but it doesn't just list the strategies, it outlines the actual cash outlay you need to make in order to be able to get those deductions. Then we'll either have a meeting or a phone call or a Zoom discussion with you to run through that report so that you know exactly what you need to do to implement these strategies before 30 June. The second thing we do, if you have a trust that's earning profits, is, like Leisha mentioned in the slide before, is we can help with trust distribution resolutions and also dividend minutes. So trust distribution resolutions and dividend minutes must be done before 30 June. It's really important. We've mentioned it before, but it's worth mentioning again. It is an ATO focus. If you don't have that trust distribution minute in place by 30 June, then you are opening up the trustee to pay tax at the highest marginal rate of 47%, which none of us want. The third way that we can assist is with cash flow planning around tax payments. So we can calculate and estimate what tax payments you're going to make over the next 12 to 18 months so that you know upfront what you're going to be paying tax on rather than at the end of the year and then you're trying to scramble to try and find those tax payments. So if you would like to know more about any of these service offerings, please feel free to contact us.
Cool. So now we've got time for questions. So we've got a couple here. Hang on. So if I bought a piece of equipment for $140,000 today, is it deductible?
Good question. So this really comes down to the instant asset write-off, which we were talking about before. So a couple of things that are important to remember if you're buying a piece of equipment. So let's say in this example, you buy a truck for $140,000. That truck must be used or installed ready for use by 30 June 2021. It also has to be used 100% for business purposes. If you use it less for business purposes, that's okay, but you only get a deduction proportionate to the business use.
Yeah, I've actually got a war story about that. So I used to do the accounts for a pub, and it had a whole stack of pokie machines, and they bought
Very expensive.
Yeah, they bought $18 million worth of machines, and they were in a shed because they were extending where they were going to go in this pub. But because they weren't plugged in on site, ready and available for use, we couldn't depreciate them.
No tax deduction.
No tax deduction. Big ouch. Yeah. And pubs make or used to make a lot of money, and they're the main poker machines are main income generators.
And then you can't get the corresponding tax depreciation deduction for them. Yeah.
Okay, do we have another one?
We do. Should I be paying myself wages out of my company or paying dividends?
Yeah, so I'll take this one. So I always look at it commercially first, but the answer really is always it depends, and that's what we work through our scenario. Because if you have mum and dad, it's very different if you have multiple shareholders and people working in the business, for example. And we might pay a dividend, and you might be able to get cash back out of it, which is
franking credit.
Which is awesome. Or we'll pay you a wage because it limits if you've dragged money out, we'll take it as a wage. So there's lots of opportunities because it stops the Div 7A situation from arising. But there's lots of things that you have to think about, like super on that wage and the timing of everything. So the sooner we do that, and STP is killing that. So with all of this has to be done before 30 June, but it's just working out the scenarios and the best tax fit for that particular family group.
Yeah. So as in all tax questions, it depends.
Yeah, I hate that, but yes.
It's a cop-out, but it's true. It is true. Okay, I think we have time, just checking the time. We have time for one more question. Okay.
Take this one.
Okay, so how beneficial is it preparing a motor vehicle logbook, and are there always tax benefits in preparing a motor vehicle logbook?
They suck.
They do. So, did you want to take this on, or would you like to? Okay, sure.
You talked about it on the slide.
Okay. So, I'll start off with the premise that look, motor vehicle logbooks are super painful to prepare because you basically have to keep very detailed records of all your trips for 12 weeks. However, if you feel that you're using your motor vehicle quite substantially for business purposes, then it is absolutely worth keeping a logbook for your motor vehicle travel. If you are only going to use your motor vehicle sporadically for business purposes, so let's say you drive from home to work, that's personal. Let's say you go to a meeting here and there, but only a few times a year, it's probably not worth keeping a logbook in that situation because the cents per kilometre method will probably give you a better result. So again, it does depend. But if you feel that you're using your motor vehicle quite a lot for business or income producing purposes, then it is absolutely worth keeping a logbook and it is worth the pain.
100%.
Yeah, agree.
Cool. I think that's
they're all the questions.
Yeah.
Okay, so in closing, thank you so much, everybody, for joining our webinar today. We hope you found it useful and we hope that you got a lot of value out of the webinar. When you exit, please complete the exit survey. We actually do read them. We actually really look forward to the results. We like to see what you write and how you rate us. It's really important to us. If there's any future topics that you'd like to hear about, please let us know. We hope we've given you plenty of ideas to ponder and some clear steps for you and your business moving forward. If you have any questions at all, feel free to reach out to Leishan or myself or our wonderful team. We're all here to help you and have a wonderful afternoon. Thank you, everybody.
Thanks, everyone. See you later.